Welcome back to Investing Talk Podcast.
Today we're looking at stock.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. For any investor coming to this company, the most fundamental thing you have to accept is that this is a pre-production uranium developer.
Right. This isn't a major producer we're talking about. Not yet, anyway.
Not at all. Their current operations report, minimal revenue and net income is firmly in the red.
Which means you are absolutely not investing in quarterly earnings or what they're making right now.
Exactly. The whole reason to be interested here, the entire investment thesis, is driven by asset valuation. It's about future cash flows.
So you're basically betting on them successfully building out this massive mine. It's a pure leverage play on what's to come.
That's the perfect way to put it.
Okay, so let's unpack that. Where is all this future value supposed to come from?
It's all concentrated on one key asset, the flagship Phoenix ISR project at Wheeler River.
ISR, that's in situ recovery.
Yes. And this project is the inflection point. It is the reason you're looking at the stock. All the technical work shows it is essentially construction ready.
Just waiting on those final approvals.
It's waiting on the final regulatory pieces to fall into place. If they can pull this off, the project is set to turn them into a real producer by mid-2028.
And that 2028 timeline is huge because that's right when everyone expects the uranium market to get really, really tight.
It aligns almost perfectly.
I mean, what does this mean in, say, the Canadian context? Is this a big deal?
Oh, it's a massive deal. If this moves forward, it's expected to be Canada's first new large-scale uranium mine since Cigar Lake.
Wow. Okay, so that gives you a sense of the scale we're talking about here.
And if you zoom out to the global picture, Phoenix becomes even more critical. It's one of only a handful of meaningful new supply sources expected to come online before 2030.
So it's a direct answer to that supply problem everyone's worried about. This isn't just another mine, it's strategic.
Highly strategic.
All right, that brings us to the economics. The big question with any project like this is always the cost. What's it going to take to build it?
And they've recently updated that. The initial capital cost for Phoenix is now pegged at around $437 million US.
Which translates to about, what, 600 million Canadian?
Roughly, yeah.
Yeah.
$600 million. And that's on what they call a Class 2 budget basis, post-FID.
Okay, let's pause there. You just used two big industry terms. FID is final investment decision. That's the green light.
Correct. The moment the board says go.
But what about Class 2 budget? For someone investing, what does that actually mean? Is this number solid?
That's the crucial question. And a Class 2 budget means they've done detailed engineering work. It's not a back-of-the-envelope guess. It signifies a much higher degree of certainty, usually within a, plus or minus 10 to 15% range.
So management is basically telling the market, look, we've factored in inflation, we've refined the scope, and we think this $600 million number is going to stick.
That's the message. And yes, it does represent about a 20% increase from earlier estimates.
Which is pretty standard these days.
It is. But the key thing that makes it work is the potential operating margin. Feasibility studies still show Phoenix and the other deposit, Griffin, could be among the lowest cost uranium mines in the world.
And that's the real metric that matters in a commodity business. Low operating cost means you can survive, even thrive, when prices are down.
It's your buffer. It's what determines your survivability. High-cost projects get shut down in a downturn. This one is designed to keep printing cash.
So this low-cost potential, that's what underpins their financial strategy leading up to the build.
Absolutely. They've been very clear about maintaining a strong liquidity position, and they're doing it mainly with equity and joint venture funding.
Not loading up on heavy debt.
Exactly.
Why is that so important at this stage?
It's all about de-risking. It's a trade-off, between dilution and leverage. If you take out huge loans now and then permitting gets delayed by a year,
those interest payments could kill you before you even start.
They can crush a company. So using equity and JV partners, you share the risk. It might mean a little more share dilution down the road, but it removes that immediate insolvency threat.
So when we see negative free cash flow on their statements right now, we shouldn't be alarmed.
Not at all. That capital is being reinvested very strategically. They're sending that money to remove technical risks, doing complex field trials, freeze wall testing, things like that.
Okay, let's pivot to their competitive moat, because this seems to be where the story gets really strong.
It is. It starts with just the sheer size. Wheeler River is the largest undeveloped uranium project in the eastern Athabasca Basin.
But beyond size, what gives them an edge?
Infrastructure. This is so critical in northern Canada. They already have a connection to Sask Power's main grid.
So no need to spend hundreds of millions building power lines for a decade.
That part is done. It's a huge piece of execution risk that's already off the table.
That's a massive head start. But what about the technology? You mentioned ISR. They're kind of pioneering that in this region, aren't they?
They are, and that's their technical leadership advantage. Phoenix is designed to be the first ISR uranium mine in the Athabasca Basin.
Which is a much lower cost, lower impact way of mining if you can get it to work.
Right. Instead of digging giant pits, you're essentially dissolving the uranium underground and pumping it to the surface.
But the geology there is tricky. How do they know it will work?
That's where all that strategic spending went. They've done extensive lab work and, most importantly, a successful large-scale field test to prove the concept works in that specific environment.
So they basically created the playbook for ISR in the Athabasca.
And that gives them a first-mover advantage that would be incredibly difficult and expensive for a competitor to replicate.
So they have the tech, the power grid, and they keep expanding their land package too.
They do. They control about 457,000 hectares, and they just added 4 new JVs right next to Wheeler River.
So this isn't just a bet on one project, it's a bet on controlling a whole district.
A very significant portion of arguably the world's best high-grade uranium jurisdiction.
Hmm.
If Phoenix works, the value of all that other land just explodes.
And it seems like the market is starting to price that in. We've seen reports of the stocks surging, what, 24–25% in a single week recently?
Yeah, there's definitely a momentum-driven breakout happening. It's fueled by that construction readiness news and, of course, a strong uranium price.
But it's not just retail investors jumping in.
No, the institutional support is there. You see analysts raising their price targets. National Bank Share set a new target at C$4.85. Canaccord went to C$5.
That's a strong signal of confidence that they can handle the updated budget and still deliver huge value.
It is, and it's all happening against this perfect macro backdrop. Uranium is in the low 80s per pound, and every Western utility is scrambling to secure non-Russian supply.
It's a huge tailwind for a low-risk Canadian developer.
The timing, as we said, could not be better.
Okay, we've laid out the bull case pretty well, but nothing is risk-free. What are the two biggest things that could go wrong here?
The two main risks are pretty tightly related. First is just continued capital cost inflation.
Even with the Class 2 budget.
Even with that. They say the $600 million should hold, but construction is a risky business. Any major unexpected cost pressure could eat into those fantastic margins.
And the second risk has to be permitting.
Always. That's the one that causes the most delays in this sector. They still need that final federal license from the Canadian Nuclear Safety Commission.
The CNSC.
Right. And that's currently targeted for the first quarter of 2026. If that date slips, the whole timeline slips. Mid-2028 production becomes late 2028 or 2029.
So for an investor watching this, what are the near-term catalysts to keep an eye on?
First and foremost, any news on that CNSC and Saskatchewan permitting process. After that, you want to see physical progress.
Shovels in the ground.
Exactly. News about early works, on-site electrical upgrades, things that show they are actually moving forward. And then maybe some initial drill results from those new joint ventures.
It all comes back to the time horizon, doesn't it? This isn't a stock you buy for a quick pop.
No, this is a multi-year hold.
Yeah.
3 to 5 years, probably. You need that time to capture the full re-rating that happens when a company goes from a cash-burning developer to a cash-flowing producer. You're investing in that transformation.
What's really fascinating here is how this company offers this leveraged exposure to a tightening global uranium market, but through a top-tier asset. It's a bet on rising prices, sure, but it's also a bet on quality execution in a safe jurisdiction.
It's a bet on strategic execution and the rising global demand for clean, reliable, Western-allied nuclear fuel. And if this project does hit its stride by 2028, it has the potential to really shift the energy balance by providing that long-term security of supply. The question for you, the investor, is, how much is that security worth in a world desperate for power?
We'll continue monitoring this space. Make sure to subscribe and follow along so you don't miss our next analysis of the markets.